very much, Adrian. We've been discussing amongst ourselves how best to keep you informed and what obviously you all want to get out of these workshops. And I think what we're going to try and do is de-emphasize a little bit the time that's spent discussing the economics and news, etc. And it's a useful part of the webinar. A lot of people like to know what's going on, but I think we're going to try and keep it to a maximum of 10 minutes. What I'm going to do very quickly is just explain to everyone that's listening now where you can get all the information without having to listen to me go through all this. Remember, we use one of our websites for finding all the data from is Forex Calendar, so I'm going to put Forex Calendar up. Make sure you've all got a note of that. Okay, so just to recap, marketwatch.com, uk.reuters.com and bloomberg.com/news. Very, very useful sites. Okay, what I'm going to quickly do now is go back to this little compendium of charts I've got here. Quite a lot has happened this week. We've had a significant move precipitated really from the US that's had a fairly marked impact on our markets yesterday, along with the news from Spain, from one of these peripheral Eurozone countries auctioning off their bonds, which didn't go down well. Here we can see a graphic illustration of what's happened here. In the middle chart here, where my cursor is, we've got dollar-euro. You can see that dollar-euro has turned down, and in all likelihood it's going to rotate back down to this sort of 130.50 level. This is a daily chart. All these charts are daily. So with the dollar rallying, this is the dollar-euro, or euro against the dollar. So it's the amount of euros to $1. The dollar is rallying. When the dollar rallies, it has an effect on dollar-priced commodities. Dollar-priced commodities, this one on the top left, gold. Gold has come down sharply. Since yesterday morning, we've fallen at least $50. A very, very sharp move. Another impact, I can show you some bond markets. Let me just click on, if I can get this German Bund, I think we can try and get that. Control S. GVM2 DT. This is the German bond market on the bottom right. So as you can see, as equity markets have fallen, bond markets have rallied. So dollar rallies or euro falls, gold falls, equity markets fall, and the bonds rally. So that's the correlation between them. So we've seen all that happen this week. Very, very interesting moves. As I say, if I click on the FTSE again on this bottom left chart, you can see how volatile we had that move on Monday, as Adrian was explaining, the first day of the week, first day of the month, first day of the quarter, where my cursor is, we had that big up move of about 100 points, followed by a pullback on Tuesday, and this dramatic fall on Wednesday. Why has it all happened? Next part of the equation. Let's just go back to our news. And if you recall, we're looking at our calendar. We looked at it on Monday. On Monday, we discussed the key events of the week. One of the key events was this FOMC. This is the minutes for the Federal Open Market Committee. This is the rate-setting committee in the United States, the largest economy in the world. In essence, the markets are hooked on the heroin of QE, and the minutes from the FOMC meeting were released on Tuesday evening. Had a bit of a negative effect on the market, a positive effect on the dollar, but basically the result of that was that there is unlikely to be any third round of quantitative easing, or QE. This is the printing of money, and that is looking increasingly unlikely. I always felt it was myself, and so on Wednesday morning, when the markets opened, we had a significant fall in equities, and that was also prompted as well by problems with Spanish debt. The Spanish borrowing costs rose sharply yesterday. Here's a headline on the Reuters, UK Reuters page. Spanish debt yields rise as recession fear grows. And that really was, they had an auction yesterday in Spain, selling bonds, and it failed to reassure investors about their sort of plans for what are very, very deep cuts in the budget in Spain, probably since in the post-Franco era. So far, I think they've agreed in their budget to cut 27.3 billion. They're raising the corporation tax and they're freezing public sector pay and cutting something like 17% of government spending. But really, it looks like the Spanish bond markets are only being supported by the Spanish banks. The Spanish government sold 2.6 billion of debt, which is really at the lower end. And there is a fear that the only reason why Spanish banks are able to buy Spanish bonds in these auctions is because of this European Central Bank long-term refinancing operation, or LTRO, and that really is another drug like QE. So Spanish yields, the yield on the bonds is inversely proportional to the price. So when yields go up, prices come down. Why is the yield so important? Well, basically, if the Spanish government want to raise money, they have to sell a bond, a bit of paper, an IOU, and it carries a coupon or an interest rate. If that interest rate goes up, it's going to cost them more to finance their borrowing. Very, very simple. If you're going to borrow money from a bank at 5%, it's going to cost you one thing, and if the rate goes up to 10%, it's going to cost you double. Very, very simple. The big irony, of course, is that the higher the interest rates go, the greater the cost to the government and the greater the fiscal problem that the Spanish government will have. Putting in perspective, the yield now on 10-year Spanish bonds is around 5.7%. So that's the highest since January, it's all sort of really tied into each time that the European Central Bank has done these two phases of LTRO. The yields have come off, but we're certainly visiting higher yields again. And one of the measures of the stress and strains within the Spanish bond markets, when they measure it against the lowest yielding bond in the Eurozone, which is the German bond, or German Bund as it's called, and the difference between Spanish and German bonds is now 3.88%, so that's the highest since November. So particularly worrying, and just a reminder that all is still not well in the Eurozone. No news tends to be good news. The LTRO has helped the market stabilise, it's given the market confidence, but it hasn't solved any of the problems in the Eurozone and the peripheral countries though.